Ladies and gentlemen, welcome all to Ignitis Group results for the first half year of 2023 call. Thank you for joining us today. Today, Ignitis Group CEO Darius Maikštėnas and CFO Jonas Rimavičius will present the group's strategic progress, financial performance highlights, as well as outlook for 2023, and answer your questions. I, Aina Rifel-Binkevičienė, Head of Investor Relations, will moderate this call. And now, I hand over the floor to the speakers.
Good afternoon, everyone, and thank you for joining our earnings call today. I will begin with the highlights of the first 6 months of 2023. First, we have made significant progress on the strategic front, particularly in the development of offshore wind, which brings us closer to accomplishing our strategic goals. Second, we continued leadership in sustainability area, which was reflected in improved Sustainalytics ESG risk rating. Lastly, we have demonstrated strong financial performance as our year-over-year adjusted EBITDA grew by 22.8% and amounted to 253.3 million euros. Also, in line with our dividend policy, for the first half of the year, we propose a dividend of 0.643 euros per share, representing a 3% increase compared to the last dividend paid. And in turn, we reiterate our full year 2023 adjusted EBITDA guidance of 480 million euros. Let me now move on into each of highlight separately. Since the beginning of 2023, we achieved important milestones across green generation portfolio. Starting with significant progress made in offshore wind development front, the group, together with partners Ocean Winds, became the provisional winners of first ever 700 MW Lithuanian offshore wind tender. In addition, we have entered in the partnership with Copenhagen Infrastructure Partners to participate in the upcoming Estonian and Latvian offshore tenders. This progress brought us closer to achieving our strategic goals of securing one offshore wind development project in Lithuania with COD until 2030 and increasing green generation capacity 4 times from 1.2 gigawatts in 2022 to 4 to 5 gigawatts by 2030. Turning to onshore wind, our first fully built project in Lithuania, Mažeikiai Wind Farm, has reached COD. In addition, we have acquired 2 new projects in Lithuania with the total capacity up to 300 megawatts. Moving to our solar portfolio, we have increased secured grid connections by 590 megawatts, predominantly as our 3 projects in Lithuania and Latvia, after successfully securing the grid, have moved to advanced development stage. Lastly, final investment decision for Kruonis PSHP expansion project was made, moving project to the construction phase, while hot tests in Vilnius CHP biomass unit have begun. The progress achieved across our green generation business segment resulted in portfolio increased by 1.2 gigawatts from 5.1 gigawatt to 6.3 gigawatt. Secured capacity growth by 0.9 gigawatts from 1.6 to 2.5 gigawatts. And additions to the installed capacity by 63 megawatts from 1.2 to 1.3 gigawatts as the result of Mažeikiai Wind Farm COD in mid-August. In terms of our portfolio split by technology, the largest share continues to conclude onshore wind and solar projects. Regarding the geography, the largest share of projects is settled in Lithuania, followed by Latvia and Poland. Finally, 5.2 gigawatts out of our portfolio concludes generation assets, and 1.1 gigawatts provide flexibility. Continuing with the progress made in other business segments of ours, in network segment, WACC methodology was updated in July 2023, which will enter into force from 2024. For 2024, this update has resulted in electricity and natural gas WACC increase by around 1 percentage point, or to 5.09% for electricity and 5.03% for natural gas. Thus, in turn, it will have a positive impact on segment's performance. Also, we successfully continue smart meters rollout with total number of installed meters exceeding 500,000 in July. Lastly, a 10-year investment plan was submitted to the regulator for review with total investments reaching 2.5 billion euros, compared to 1.9 billion euros in the previous plan. In reserve capacities, TSOs of Lithuania, Latvia, and Estonia agreed on concrete steps to synchronize the electricity networks of the Baltic countries with Western Europe in February of 2025. And on customers and solution side, we have announced plans to invest up to 115 million euros to develop EV charging network across the Baltics over 3 to 5 years. Next, I would like to highlight the progress on our sustainability initiatives. Our commitment is evident in reduction of greenhouse gas emissions. This is aligned with our long-term goals of minimizing the environmental impact. Our year-over-year greenhouse gas emissions decreased by 6.4%. This was primarily driven by two key factors: improved natural gas accounting measures and lower retail of natural gas sales. In addition, our year-over-year green share of generation remains stable at 92% level, despite a slight absolute decrease in the net generation due to the fewer days of favorable conditions for generation in Kruonis PSHP. Furthermore, our employee well-being and safety remain a top priority. We take proactive measures to improve the culture of occupational health and safety inside the group and with contractors. Hence, our year-over-year total recordable injury rate for employees improved to 0.78. Overall, our long-term commitment to sustainability has resulted in an improvement in Sustainalytics ESG risk rating. In April, Sustainalytics updated our rating from medium to low ESG risk level, placing the group in the top 13% among peers globally. For now, I conclude the overall our strategic performance and pass the word to Jonas to cover the financials.
Thank you, Darius, and hello everyone. Let me begin with the financial highlights of the first half of 2023. We have recorded 22.8% higher adjusted EBITDA, which reached 253.5 million euros, up from 206.5 million euros last year, driven by better results of customers and solutions and reserve capacity segments. In turn, it led to growth in adjusted net profit, which increased by 39.1% up to 150.1 million euros compared to 107.9 last year. Adjusted return on capital employed has also increased and reached 11.3%. We have also boosted our investments substantially this year, which reflects our progress on green generation portfolio. Investments have more than doubled and reached 402.6 million euros in the first 6 months of the year. A large investment program has not impacted our leverage metrics yet, as our FFO to net debt remains stable at 48%, while net debt to EBITDA has even declined to 1.9 times. This was mainly driven by the decrease in net working capital. And lastly, regarding shareholder returns, as usual, we proposed a 3% higher dividend than last year, which is in line with our dividend policy. For the first 6 months of 2023, we propose to pay out 64.3 cents of dividend per share. Now let's look at our main numbers in more detail, starting with adjusted EBITDA, which grew by 47 million euros year-on-year. The main drivers for growth were as follows. So in customers and solutions, which adjusted EBITDA grew by 26.4 million euros and turned to positive territory, the main driver was higher B2B natural gas results. However, B2C electricity activities continued to be loss-making. In reserve capacity segment, adjusted EBITDA grew by 24 million euros, and this growth was driven by a utilized option to earn additional return in the market on top of a regulated return by fixing positive forward clean spark spread. These two segments, customers and solutions and reserve capacities, were the main drivers behind EBITDA growth. In terms of other segments, networks grew by 6.1 million euros, mainly due to higher RAB, and green generation recorded a decrease of 10.3 million euros, mainly as a result of lower power prices, which was expected. Next, let's review the financial results of each segment in more detail. Starting with green generation, it remains the largest contributor to our group's adjusted EBITDA, accounting for 43% of the total, despite year-over-year result decrease by 8.6% from 119.4 million to 109.1 million euros, driven mainly by lower power prices. Looking at the results across different technologies, onshore wind EBITDA decreased by 11.1 million euro, which was driven by lower captured electricity price, especially in Pomerania wind farm, where last year we sold around 80% of electricity on high market prices, while this year we are selling 100% under lower CFD subsidy scheme. Another factor was lower volumes generated, as load factor decreased from 35.9 to 30.4%. Hydro EBITDA decreased by 7 million due to less favorable spread between peak and off-peak prices and lower volumes generated. Biomass and waste energy EBITDA partly offset the decrease in other technologies and grew by 8.3 million euros as a result of growth in captured electricity and heat prices and higher electricity volume generated. Moving on to networks, adjusted EBITDA grew by 7.4% and amounted to 88.7 million euro. The increase was mainly due to higher RAB value, which increased by 6% from 1.3 to 1.4 billion euros. Reserve capacities adjusted EBITDA increased by 24 million euros and reached 32.2 million euros, mainly as a result of already mentioned utilized option to earn additional return in the market on top of the regulated return by fixing positive forward clean spark spread. Lastly, year-over-year customers and solutions adjusted EBITDA turned positive and reached 21.7 million euros, which the overall result of which was driven by better B2B natural gas and B2B electricity performance, which was partly offset by loss-making B2C electricity activities. Next, our year-on-year investments more than doubled and reached 402.6 million euros in the first 6 months of 2023. The main drivers behind it were as follows. Firstly, more than a threefold increase in green generation investments, mostly directed towards new wind farm projects in Lithuania and Poland, as well as Vilnius CHP biomass unit and Kruonis pump storage plant expansion project. It is worth highlighting that investments made in green generation accounted for almost 60% of the group's total investments. Secondly, higher investments in electricity network, which were driven by higher contractor fees and higher volume of works performed, as well as smart meter rollout, which we launched in July last year. Moving on to our net working capital and free cash flow figures. Lower level of inventory and lower energy market prices resulted in reduced net working capital. It has decreased by 56.9% since the end of 2022 and reached 191 million euros as of middle of this year. As a result, net working capital improvement and adjusted EBITDA growth resulted in free cash flow turning positive and reaching 50.2 million euros in the first half of 2023. Regarding our leverage metrics, since the end of 2022, our net debt slightly decreased and stood at 966.7 million euros at the end of June 2023, while FFO to net debt remained relatively flat at 48%, remaining well above 23% threshold required by S&P for BBB+ credit rating. Net debt to adjusted EBITDA has decreased from 2.1 to 1.9 times and continues to be well below the 5 times threshold of our strategic plan. Finally, our guidance for 2023. As a result of solid performance during the first 6 months of 2023, we reiterate our full-year adjusted EBITDA guidance and expect it to be in the range of 430 to 480 million euros. There are no changes in the directional guidance of our segments either. With that, I pass the word back to Darius to conclude our earnings call.
Thank you, Jonas. Let me sum up Ignitis Group first half-year performance. A significant progress was made in our green generation segment. Our portfolio increased by 1.2 gigawatts to 6.3 gigawatts, while our installed capacity grew by 0.1 gigawatt to 1.3 gigawatt. In addition, progress made in offshore wind development front brings us closer to strategic goals achievement. In addition, progress on sustainability was reflected in upgraded Sustainalytics ESG risk rating from medium to low risk, placing Ignitis Group in the top 13% among utility peers globally. Lastly, regarding our financial performance, Ignitis Group adjusted EBITDA grew by 22.8% year-over-year and reached 253.5 million euros. The result was driven by customers and solutions and reserve capacity segments performance. Turning to shareholder returns, in line with our dividend policy, we propose to pay a dividend of 0.643 euros per share for the first half year of 2023. And lastly, in terms of full year 2023 outlook, we reiterate our adjusted EBITDA guidance and expect it to be in the range of 430-480 million euros. So with that, thank you for staying with us, and now we are open for your questions.
This concludes our presentation and opens the floor for a Q&A session. Operator, handing over to you.
Thank you. As a reminder, to ask a question, you will need to press star 1 and 1 on your telephone and wait for your name to be announced. To withdraw your question, please press star 1 and 1 again. If you wish to ask a question via the webcast, please type it into the box and click submit. Please stand by while we compile the Q&A queue.
Thank you. To begin with our first question, why you are not going to participate in the second Lithuanian offshore wind tender?
Thank you. In our strategy, we have set a goal to secure 2 offshore wind development projects in Baltics, one in Lithuania with COD until 2030, and one more project in our home markets with COD post 2030. Since both Lithuanian offshore projects have COD by 2030, participating in the second one does not meet our strategic objective. We have deliberately chosen to secure 2 projects with 2 different COD dates because of capital intensity that offshore projects require. Delivering 2 offshore projects on the same time would be difficult to finance and would create tension for our leverage metrics.
Our next question: what can we expect from Ignitis Group in future in terms of dividends?
Yes. So in terms of dividends, we remain committed to our dividend policy, which foresees 3% minimum level of annual dividend growth. And in line with that, for the first half of 2023, we propose to pay a dividend of 0.643 per share, corresponding to 3% growth year on year. Of course, subject to the decision of our EGM. And currently, this corresponds to a dividend yield of almost 6.5%.
The next question: what are the main issues why electricity B2C sales brings only losses to the company? And does the company have a clear plan how to solve it? Thanks.
Thank you. Customers and Solutions business segment was significantly affected by extreme energy market conditions, causing volatility in wholesale prices over the last couple of years. In turn, it resulted in B2C electricity activities being loss-making with total loss of 23.2 million euros in 2022 and 17.5 million euros in 6 months of 2023. However, out of 70.5 million euros loss in first half of 2023, the majority of it, 16.4 million euros, were accumulated during first quarter, adding only 1.1 million euros in the second quarter, demonstrating a slowing pace. Finally, it's important to understand that given the undergoing market liberalization, at the same time it caused a few market players to bust and us to step in. So largely, we see it as investment into our client base, which has increased our market share and will generate future revenues from the segment.
The following question: could you please provide some flavor on what kind of return on investment one can reasonably expect on 115 million capex into EV charging network and Customers and Solutions?
Yes. So in terms of our typical returns, as you know, we aim for between 6.5 and 7.5 return on capital employed. However, this being a higher risk project than our typical one, we would expect to earn more than that for this investment.
The following question: how do you see offshore wind installation prices would move in the future? Do you have some strategy to fix the installation prices already now, or the project would be done with the price that would be available when reaching near construction period?
So in terms of fixing the prices, the base case is to fix the prices closer to final investment decision, so which is still a few years ahead of us. In terms of trends in offshore wind installation prices, we see that the prices have stabilized to some extent, but again, forecasting at this point would be difficult.
The next question: when a construction works of first offshore wind park could begin, how much they will cost? Is it possible to finish construction works until 2028, as expects the Ministry of Energy? What main challenges do you see in the construction process?
Yeah. So in terms of start of the construction works, so we expect to make final investment decisions around 26, 27, and that's the date for start of the construction, so that we are ready to operate by 2030. Finishing construction work by 2028 is an ambitious timeline. We haven't ruled it out fully, but it is ambitious. Our goal is to finish by 2030. In terms of the costs, so At the moment, we can give you only rough estimate, which is around 3 million per megawatt, which results in the total project cost of slightly above 2 billion euros. And in terms of the main challenges for the construction process, these are quite typical for such type of projects. So managing the logistics, securing the right suppliers, making sure that the port is ready for the construction, securing the right people, so all the usual ones.
The next question is, solar installation prices in EU went significantly down in recent months. Does Ignitis get some benefit from it, or Ignitis solar projects installation prices are fixed, meaning that projects are to be constructed at higher than nowadays market price?
Yes. So in terms of maybe I will comment on our project. So we haven't secured any projects with higher prices which we've seen in the past. So the projects which are proceeding right now are based on the competitive today's solar panel prices.
The following question: can you get us wider understanding about partnership with CIP? How many gigawatts it is expected to construct together? Would Ignitis be a major or the minor stockholding partner in the partnership?
Yeah. So in terms of partnership structure, so it's a partnership of equals, 50-50, and in terms of our plans for how many gigawatts we expect to build together, so the plan minimum is to secure one more project in the Baltics, in the offshore, with COD post 2030. So we expect to have at least one more project out of this partnership. And going forward, we'll see how it looks like after our first experience.
One more question. Could you elaborate further what were the factors affecting B2B natural gas operations in customers and solutions segment, which led to strong EBITDA improvement?
Yes, so there were several impacts in B2B natural gas operations, but so the main factor was the strong performance by the team, fixing solid margins already last year. So that was one impact. Second impact, which impacted our results, was also the partial reversal of impairment in natural gas inventory, which we made last year. So this year it was partially reversed. That also had a positive impact.
The next question. New WACC announced recently. Would impact from higher WACC start only from 2024 January? Does it mean additional adjusted EBITDA for 2024 and later on?
Yes, so that is correct. Starting from 2024, this 1 percentage point WACC increase will mean that so currently we have a regulated asset base of 1.4 billion. So this one additional percent means plus 14 million of adjusted EBITDA on top of what we have right now, and it's a sustainable effect going both for 2024 and later years.
Following question. Hedge electricity price 150 euros per megawatt hour for 6 months 2023. Could you please indicate what was the hedge price in Q2 standalone?
So, not going into detail, the level is relatively the same, because the contracts which were fixed, they are not quarterly contracts. They are longer-term contracts. Hence, the hedge price level is the same. What was lower in Q2 was the market price, which was the unhedged part of the portfolio, and that has dropped in Lithuania roughly from 100 euros per megawatt hour to 80 euros per megawatt hour.
Our next question is: investments already reached 400 million euros during H1. How many investments is expected to reach during the whole 2023 year?
Well, although we are not providing a guidance for the full year capex, but you can expect at least the same number for the second half.
One more question: what level of contribution can we expect for EV charging in 2023 and also 2024?
Very minor. It's we are in the initial stages. The main focus is now on securing the locations. Naturally, that the utilization factor of these locations in the first years will be lower, so the overall impact for our adjusted EBITDA is negligible. It's a long-term play.
And the final question is: what kind of capex per megawatt are you currently seeing on the market for onshore wind farms?
Yeah, so we haven't seen major changes since what we presented in Q1. We haven't contracted major items, so there are no major changes in capex per megawatt. What we've seen in Q1, meaning that it's around 1.5 million per megawatt.
Thank you. And as we have no further questions, we will now close the presentation. Should you have any questions, please contact our IR team. Thank you again for participating in our results call, and enjoy the rest of your day.